Hey, everybody. Welcome to the Risk and Roll podcast, or whatever we decide to call it in the future. Right now, we love that name and we're sticking to it. And with me today, we've got quite the smorgasbord of really experienced professionals in all sorts of the field of mortgage except sales. Every single one of the people on here is an expert in their field when it comes to what they do. So I'm going to run around the horn from what I can see here. Ray Snitchel, Loan Risk Advisors, is with us. When you're like, hey, is there an attorney here? Absolutely. But better than that, we've got two of them. Bob Simpson with Daylight AML also is here. He's going to head off the entire topic for today's episode. Dana Giorgio with Lending Luminary, really somebody who you're like, I wonder if anybody's been in the industry for a couple decades knows how to use AI. She's like, yeah, I do. And I'm going to tell you all about it. So she's got a lot of great insights. And then Greg Olivan, he and Polygon Research with Val, like they do so much when it comes to pivoting the data that we're like, why in the world am I doing MCRs again? And why is the state going to find me if I don't get this in time? And Greg's like, I'm waiting. I want to see the data. So Greg's that guy. And we're going to talk a lot more about that. But I'm Nathan Nottingham with MLO Force. We're a training company that just tries to make it more exciting and engaging everywhere you look. Okay, topic. Bob, you kicked it off for this episode, and you said, look out. It's 2026. What are you thinking?
We got stuff coming, and first thing I want to say is to all of the BSA officers that I work with, because my specialty is BSA audits and education, is I'm not talking about you or the matters that we've just been talking about in the last 10 days. Don't take this personally, okay? I am observing with my clients, my BSA officers, a couple of real anxieties. One is the collision between production and quality control and compliance. Just hearing from somebody who says, I have a real trouble with the president of my company telling me not to file a suspicious activity report on that guy because he's my top producer. And the other thing that I'm finding is a common theme is that people don't quite know how far to dig when they're digging into potential fraud. So you get a suspicious, crummy deal from one of your local real estate agents, and they were encouraging somebody to falsify employment. When you are then doing your know your customer and trying to figure out, are my business partners honest, good people to be working with, do you check that realtor out? Do they end up on your internal watch list? And I'm getting responses wildly across the board from that. So there's a lot of uncertainty with compliance and BSA people about kind of their role in this world right now in a tighter origination environment where everybody might try and push things through that maybe a year or two ago you wouldn't have pushed. So they're coming at you. They're coming at your QC team. They're coming at your underwriters with stuff that's a little sketchier than maybe it used to be. I mean, we're seeing false employment. We're seeing everything down to falsified HOA letters. So did you have the right owner occupancy? Did you have the right reserves? Those letters are getting falsified. And so now you've got a problem. You're the BSA officer and you're supposed to track and report this stuff. But what if that is your top producer? Because a lot of your lower producers, frankly, are done. They're gone. The number of licensees is down. So what's your responsibility? I just want to communicate to my BSA audience out there, you're not alone in having to deal with this stuff. Everybody's kind of facing these issues. So there.
Man, the numbers of loan officers is falling. We've continued to see that. Our renewal structure, we're still coming back down. We're getting right back down to 2018, 2017 numbers. And so, yes, it's like
Nathan,
losing a loan officer that produces.
What are those numbers to give me an idea? Well, what are they?
Sub 130, I believe, 130,000.
Okay.
And we were upwards of 200,000, 2.5 years ago. So more of that will come out. The NMLS, when they do release those numbers, it's about a year late. So it's hard to tell unless you have the direct access. But yeah, it's going to be hard to take action and say, hold people accountable, especially top producers who like, my business is already shrinking. I got to maintain as much business as possible. But Ray, let me kick it over to you. Loan Risk Advisors, when it comes to risk, you like to weigh it carefully.
Yeah, you're going to have to weigh it carefully. It's always the case. I mean, if you have the resources to be always right and no risk all the time, maybe you're not doing it right. But so here are my thoughts. You know, we're talking about 2026 and what are we going to see for risk, particularly in my space and compliance. Now, we are about a year in with the CFPB being dethroned as the supervisor, you know, the king
Yeah.
supervisor for mortgage lending and particularly for non-depositories, which we have for almost over a decade. We're dealing with CFPB, so we knew. What did we say last year? Last year we said, guess what? The states are going to get more active. Guess what? My expectation, my experience. In 2025, dealing with my clients, they were very active. Now, when I say active, they're going to do their routine examinations on schedule. That's not the issue. But the issues that they're bringing up in the examinations, the level of detail they're expecting from us to provide to clear issues and to explain how we do business and what the issues are. That's what we're seeing a lot more of. So, we pick up on these trends of what's really seems to be on their mind. And so what I expect in 2026 is going to be no different than what we were talking about in 2025, and that is the states are going to be more active. They just are, one way or the other. Again, what I'm seeing is, although we can look at enforcement's probably increased as well, do see a little bit of that. It's just the routine examinations that people are dealing with. That's the same, but it's the quality of the examination just goes deeper and sometimes can make you nervous simply because, not because you're wrong, but because you don't know if you have the exact information they're asking for. So let me tell you the kind of things that I've been seeing as a matter of trending. One is marketing compliance. So advertising and marketing compliance, that seems to be on the radar. Not just, we know notoriously, Washington is notorious, state of Washington is notorious for marketing compliance and writing consent orders, et cetera, on marketing compliance. So we knew that, and yes, that's happened. We're seeing now in other states as well asking about the marketing, your marketing compliance plan, and how are you doing? And of course, then kind of escalating, here's what we see in concerns that we have in marketing in whatever state they're in. So they're getting more active in marketing compliance. And if I give you a hint on that one, by the way, guys, let's not use the word best or lowest. We all know we shouldn't be doing that in our advertising. And let's keep it simple. Some of the fundamentals. If you're going to have an interest rate, you need a corresponding APR. Don't forget. And don't forget, we've got the fundamentals anyway, which is NMLS number, consumer access link, the equal housing logo, and of course, at least company name. So don't be blind. These are the kind of things that we've been seeing. So I know states are going to be active in looking at marketing. The other one that I've noticed, and it's interesting, it's coming up, it's bubbling up, and that's the use of unlicensed third-party loan processing companies. Now, loan processing licensing, particularly as a third party, is not the same for every state. Sometimes it's the company, sometimes the individual, sometimes both or either, depending, sometimes neither. It depends on state to state issue, but I've been seeing more of a trend of people asking about what loan processing company are using. Is it a third party and are they licensed? So that seems to be bubbling up. And then the other one, and we've kind of seen this trend, but I still think it's a little bit more, and Bob will be thrilled about this, and that's AML BSA, and now even red flags. What's your red flags training? What's your AML BSA training? One of the things we notice, and maybe Nathan, you can speak to this, is we believe that continuing education for loan officers contains AML training and even red flags. But when the states want to see, hey, did they have the training? It's not necessarily clearly on the syllabus, or unless you get the detailed syllabus, but it's not obvious in the NMLS that the syllabus included for the loan officer, particularly AML and particularly red flags. So that's been bubbling up in state exams. They're starting to grind into marketing, they're starting to grind into licensing issues, and they're starting to grind more deeply in AML BSA. And I'd say particularly the training part of AML BSA. So in 2026, I expect it to be the same, and I'm sure it'll be trending other issues by 2027. We'll have other topics, but that's what I'm seeing. Yes, states are getting active, and like what we predicted. And so just be prepared for those, and you're not the only one. If somebody's out there and saying, man, that South Carolina attorney forum that we've been doing since the 90s, they're really getting much pickier about it. Like, you're not imagining it. That's exactly true. That's what's happening.
Yep.
And Ray, isn't this a real, I mean, it's a challenge. I talk to lenders all the time, and the non-standardization that we see between states is really what's giving a lot of the heartburn, right? If South Carolina was doing it the same as Washington, we'd probably all be fine, right? It's much easier
Correct.
than to prepare and set that standard, but that's not the case. And so, from a lender's perspective, compliance costs will be seemingly going up, right? We need
Yes.
more
Yes.
people to be figuring out, when the whole design was, hey, let's try to lower the cost to produce a loan. That doesn't seem to be the case for 2026.
No, it wasn't for 2025 as we see it, and I expect 2026. Just to dive back a little bit on the CFPB, be careful what you ask for. I mean, I think a lot of us in this industry were perturbed by the CFPB primarily because of their rule by enforcement, right? So that's how they make the rules. And even then it was unfair and we didn't understand it. It wasn't in the law. We could talk about all of that. We tend to forget the continuity they did deliver on certain things. And so that seems to be lost. Let me look at everybody here. We were all here before the CFPB, and we've had to deal with the multi-state. And one of the things we begged for at the federal level was, hey, can you get a standard regulator? We got it. In my estimation, they went a little bit outside the scope that we had hoped on a number of things, but the continuity they brought, that helped. And we seem to have lost that. But yeah, you're right. Yeah. Absolutely right, Dana.
It's a good take, especially in the training capacity, the structure there, the BSA AML, and the fact that the way the states are looking. It's what's funny to the mortgage industry. Let me say this. When a state says it's time for an examination, we want to know information, treat it like an underwriter. It's got to be super simple. Everything's labeled correctly. You've got naming, like all of it just has to be in line. Otherwise, they're going to dig deeper and deeper and deeper, and you're going to find yourself in a world of hurt. That's really good, Ray. So I'm going to move over to Miss Dana. Miss Dana, what are you seeing in 26 that's possible hurdles and or obstacles that we're going to have to start navigating?
So there's some, from my perspective, I'm somewhat in a unique position, right? Because I talk to lenders across the entire lending spectrum, right? Everything from traditional to reverse to private lending. And so let's chat about private lending really quickly, because, that's the cowboy lending of the world, right? Mm-hmm. Right now, there is very little regulation. There's only about less than a couple of handfuls of states that have any regulatory requirements whatsoever for business purpose lending, because they're under the commercial guise. I think that we're going to see states kind of, their little twinkle in their eyes for dollar signs, start to potentially change some of that, where we're going to see some new rules and regulations. And so if you're a traditional firm that's considering about opening up your product line, which I'm all about, right? The more programs and products that we can offer our customer base, the better. But I would highly encourage, from a risk perspective, that you put a Chinese wall from your traditional to your business purpose lending, even to the fact of using potentially different technology solutions, because the current regulatory environment is so dramatically different, right? There's no LEs and CDs. There's no requirements for BSA and AML training in the private lending world. Not to say that there shouldn't be, there just isn't today. So I think that the risks of those types of things are going to continue to grow as compression happens in the marketplace and lenders are looking for ways to create more revenue or scale. They're going to be looking at alternative products in the market, non-QM and this business purpose lending. And there's some real risks involved. Now, there can be great reward too, no doubt about that. But I do think that we're going to see some regulatory environment changes in regards to those types of products.
Interesting. Now, and you also said, and just to clarify, anybody listening to this, I don't know who's checking this out, if they're compliance people or not, but you said private lending, but again, it's private lending, private money, non-QM, portfolio assets, usually that lending structure, versus qualified mortgage-backed securities, traded marketplace securitized. Right. Yes.
Now, business purpose lending can include that DSCR product, which is, a securitizable asset. There's lots of securitizations out there that have that product in there. But it is a different, business BPL, business purpose lending, I qualify it that way because it comes under the commercial heading. So RTL, residential transition loans, which are the short-term things like a bridge, a fix and flip, a ground up construction, and then DSCR, because DSCR can fall under non-QM, business purpose. It can come under a number of different program headings, and the requirements can be different depending on who, the investor is for that product.
Okay, perfect. Hey, that's good to know, especially drawing the line between the barrier between the two systems, because you don't want to accidentally mix your two systems for what's required out there. And I will agree with you, non-QM, I'm starting to see some of the wholesale lenders even say, hey, we can do it in this state, but this state's changing stuff. We're not sure we're going to do it over there yet. So keeping an eye out for those. Greg, Polygon Research, your Super Bowl is coming up the end of March. The HMDA data should be released soon. Not soon enough, but soon. And what are you looking for? What are you thinking about in 26? What are the triggers? What are the look backs you're going to go, ooh, that's going to tell us a lot about where we're going?
Yeah, absolutely. And to kind of reframe what you just called out, Nathan, the CFPB is statutorily required to release the HMDA data by the end of March. I think we had more uncertainty actually in 2025 because we were in the middle of new changes. We didn't know quite how they were going to play out. And in fact, they did release the data in 2025 on March 31st, but it happened. Subsequent to that, they did what they've always done. They released updates, which consist of late filings and corrections every week. They have done that throughout the year and continue to do it this year so far. So this has built up some confidence that they're going to hit their target this year again. I think they can scale that back to a certain point, but not beyond what the law actually requires. So that's kind of the boundary there. It is our Super Bowl. It's when we get the annual update to the foundation of how we look at the world through open data. It is the most comprehensive data set out there. The Home Mortgage Disclosure Act has information about the entire mortgage application life cycle, all the fallout reasons, all the denial reasons, but then, of course, the originations in great detail on the originations across property, applicant, lender, and of course, product. Great detail on just what went into those loans, the credit box, certain elements of the credit box, the pricing on the loans, certainly the rates, et cetera. So, it's going to be a big update. In the meantime, we've been watching the secondary market data, which is sort of that second lens through which to watch what's going on in the market throughout the year. And I guess one of the bigger headlines there is concentration. The big guys are grabbing more market share. And rates have kind of been up and down. We all know that. But rates on average across the agency loans, this is Fannie, Freddie, and Ginnie, dipped below 6% for the first time in the last 3 months for one loan purpose, namely refi, rate and term refi. Finally seen that break that barrier below 6%. Overall average is still above 6%, but a little bit of interesting movement there on refis.
Nice. I'm wondering to what degree, and maybe private money has more to do with this, Dana, but do we get to see some investment asset classes going in and just trying to pre-buy certain bond levels to get the refi plug pulled from, especially when things are slowing down?
Yeah, I absolutely think that is going to be a mechanism that they'll deploy. No doubt about it. Hey, Greg, I was wondering when you said, the big guys, right? We're not talking about banks anymore, right? Banks used to be the traditional, mortgage lender when we talk about the big guys, but that's really not the case anymore. So when you talk about big guys, are you really referring to more of like the independent mortgage banker section?
Yeah. The independents have really taken over mortgage over the last several years. Rocket had about a 7-year run as the largest lender in the country, taking the mantle from Wells Fargo, which had it for many years prior. And that's sort of our theme as we're looking at 2026 is like you have to make sure that you're updating your assumptions. And that's sort of what Polygon Research is all about, is providing current deep dive data at a very granular level to help you understand really all of the dynamics in the marketplace. Because it certainly isn't banks. It was Rocket, and now the last 2 years it's been UWM as the top lender. And we see that even in the agency data I was just calling out year to date. Now, this isn't necessarily the lender. You have to know the strategy of each of these. These are the sellers or issuers of those securities. But UWM's number one, Rocket's number two, PennyMac's number three. No banks on that leaderboard list. And I could go on.
Yeah, but all three of them are running.
Lenders. Yeah.
And all three of them are running servicer lines.
Yeah.
Yep. And building into that very much so. So controlling that vertical. Bob, let's talk real quick about this. You brought up exam readiness, risk assessment, right? Getting prepared for these things. Let's take a look at the fact that you have fewer, let's just say fewer non-FDIC, non-CSBS regulated, but regulated through different channels, non-depository mortgage bankers, independent mortgage bankers. Where's the risk on money laundering here? Is there a risk? What do we see?
Yeah, so there's a disconnect between those of us in the United States and the rest of the world. The rest of the world regards real estate as the prime way to launder money. And for us, it's just an afterthought. But for the rest of the world, it's a big, big concern. So we've got high risk areas. We've got different rules that apply to all cash transactions. We've got some regulatory adjustments to get us to think about anti-money laundering correctly. Now, you mentioned risk assessment. FinCEN has given us a guideline that says our priorities are your priorities. So assess your risk according to these 8 things. And some of them just feel so estranged from what we do every day in the mortgage industry. Things like cybercrime and human trafficking, and these are the 8 priorities of FinCEN. So for anybody who wants those, I'll be happy to send you over some information on those 8 priorities. Well, yeah, sure. We've all seen owner-occupied problems where when we look at the house, it turns out to be a grow farm full of marijuana, stem to stern. We've seen homes taken over for human trafficking. I, one time, was asked to break into a home that was owned by one of my lender clients to let the FBI in because it was a terrorist nest. And I threw a patio chair through a slider. Should have seen the look on the FBI agent's face.
Wait, Bob, I have a question, Bob. Did it work on the first try? Did the chair bounce back and you had to throw it hard?
Two tries. Two tries.
Figured.
Just harder than hell. So you end up with real problems, but they're anomalies. They don't happen often. But what I find then is that people get lax and they're not quite up to risk assessment. I see risk assessments that are 1 page, right? Your risk assessment should really do a couple of things. It should outline all of your book of business, the types of loans that you do, where you do those loans, whether you're retail, correspondent. Really kind of give some thought to where your risks might come into play. If you're a credit union and you do all your business in one county in Texas, God bless you. You have a certain number of risks that you don't have if you run a correspondent or a brokerage that's dealing in 50 states and a lot of it's anonymous and you don't see who your people are. I mean, those are different risks. And what you need to do is judge the areas of your risk and the chance that you're going to end up with a problem matched with the severity of that problem. And the best way to illustrate it is, what if you miss somebody on the OFAC list? What if you have done business with Maduro's son? Okay. If you miss it, that's a big problem. Now, the chances, we all know that you don't get that many OFAC hits, right? We run drive reports or other competitors. We run the reports when we originate. But when we get a hit, it's a big, big deal. So that goes into your risk assessment. What if a loan goes delinquent? What if the income is false? What if? This is your job to do the risk assessment. And it's more than a 2-hour enterprise. It's going to take the better part of your week to really come up with a good risk assessment.
Bob, how often are you seeing, Nathan, you opened this up with, me, being affiliated with AI and AI solutions. How often are you seeing lenders now really take an eye to AI to be able to support some of that human tasking, right? Because to your point, you look at OFAC report, if I'm an underwriter and I'm looking at 50 of those every single week, am I really looking at every single line of those every single week, right? That's how human error, that's how misses happen. But when AI is incorporated into that, those misses don't happen. So is that an element that is, really being considered from a risk assessment perspective, or should it be?
So you get green checks all the way down the column and you go, hey, it looks like everybody gets cleared. But there's one mistake that I find that's more common than any other mistake where you're going to miss it. And that is the grantor of gifts, because when your loan gets originated on day one, you may not know who's giving that down payment. That may not come in till day 15. And now you've got a wild hair. You got somebody in your loan transaction. You didn't run a drive report on the grantor of that gift. Well, that is the way to launder money, is to get it to come in through gifts, right? Same with servicing records and excess payments. But the miss isn't so much in failing to order the drive report. It is in making sure that you got every party that was involved in that transaction. You'll get borrower, co-borrower, but then the co-borrower drops off to have somebody else come in. You got new players. That's where you really need systems, processes in place to when that CD when we're gonna close, everybody that was involved in that thing, there needs to be some last minute check to go, yeah, we got everybody on the list. The chances of getting an OFAC hit, again, very low. But when you do get one, and if you blow it, it's a headline risk. It's embarrassing. It can be really bad.
Yeah. Well, and it's not, OFAC is certainly, a risk. And to your point, it doesn't happen very often, but there are a lot of other risk components or, red flags that do happen oftentimes. Like we've seen a tremendous uptick in occupancy fraud, for example, right? Yep. That can be a fairly easy thing for a human to miss. And so again, I feel like there should be an eye and a conversation, and we're certainly having more conversations today about AI than we ever have in the mortgage industry, right? I've traditionally said, mortgage industry is the slowest to adopt anything from a technology perspective, right? It took us 25 years to get paperless, and guess what? We're still not paperless, right? But AUS is a form of AI, so we had some component, of that solution being happening. But now, because of the risk and as fast as it can work, I just feel like if we're not continuing to have those conversations with lenders or as a lender of looking and identifying where we might be able to adopt an AI solution to help support that risk, right? We need a human in the loop or on the loop. Absolutely. You'll never get an argument from me about that. But I just don't think that lenders are really considering you can significantly mitigate your risks for a much lower cost than a human by incorporating some AI solutions. And I didn't know if, even some of the regulatories, like, are we seeing any, of the state agencies asking about what AI solutions are being used? How is it being used? Or any of those coming up in audits, Ray or Bob?
That leads to the question I was going to lean into Bob, but Greg, did you have something you wanted to add into that?
I'll just make an interjection before Ray and Bob, you jump in with that specific answer. The interjection is this: you have to not just have a human in the loop, you have to have data in the loop. We saw, and we've navigated, and we've brought to life sort of an evolution in fair lending. Now, this is sort of related subset of compliance. It's also just doing the right thing. It's also inherently tied to strategy. Are you really covering your market and talking to everybody and selling to everybody that you should be? But whether it's underwriting, pricing, redlining, marketing, our products, when they deal at the loan level and you have every mortgage application and every outcome, you no longer have to do matched pairs or take samples or do statistical significant analysis. You're looking at everything. So I think there's an analog now with everything that we're talking about with AI is how good is the data that it was trained on, or how good is the data that it's writing a program to go and analyze, as the case may be. And I think that's something to keep squarely in mind. We need to understand how moored is the AI.
It's such a great raise up, Greg. That's one of the things I say to my lenders is if you don't have clean data, there's no second point to that conversation, right? Yeah. It has to start with the data.
Yeah.
Yeah, and I think, and Danny, you probably see this too. There's a lenders, as a general rule, their data is not as good as they want it to be. That's from their mouth, right? I'm not being critical here. They'll tell you that. So it's fun. Maybe do the same thing when I walk into a client and said, "My guess is one of your top concerns is your data." Like, how did you know? I was like, that's everybody's issue, right? So it's not magic, it's a Penn and Teller trick. So I already know. But then, yeah, you're not really ready for that. I mean, I think, going to your question, Dana, insofar as do we see it in examinations, I have not seen it directly. In fact, I checked AI. It says no. I'm kidding. But it's just I've not seen it. I've not seen it yet that much. I don't think people are using it in that regard to hedge risk or understand it. I think, we're still kind of, I want to say survival mode, but we're just trying to get business in the door with my clients, as it were. So I don't know to what degree they've used AI, but I've not seen that in the examinations yet. And yet, as I've been preaching as well with AI for a few years, and all of us I'm sure have as well, know your data, make sure it's accurate before you even use it. And the proverbial Reagan approach, trust but verify. Mm-hmm. So the verify point is extremely critical. And I think, that'll tell you if you have confidence or not.
So on that, Ray, let me just trigger one of the questions I had for you in what you were talking about, we're moving the bars. A bunch of states are asking questions. There's a few things we're looking at, but you brought up unlicensed, and especially in processing. And some states are real funky about W-2 or 1099 and what that means for the licensing of your processors and how your pay structure is. We're not talking about loan officers right here. I'm just going to raise my hand. I'm not talking LO comp right now. I'm talking processor comp. But there's licensing requirements there. So what are your thoughts there on this unlicensed activity, the crackdown? Any single piece of advice you give a mortgage company to prepare for the shift in that state enforcement?
Yes. I mean, I think, first of all, and I think it's more obvious now. In the past, maybe not. I mean, if you ask the vendor, "Hey, are you licensed?" Like, sure we are, whatever, or we don't need to be. I think now they're much more cognizant as to, if they're not licensed, or if they at least have what I call my 45-second speech, that they'll tell you, like, here's why I don't need a license, or more importantly, yes, we have a license, this is what we've done in the state, whatever it is, right? So they're more prepared for the question. They should be anyway, third-party processors. But to be clear, I think what you'll want to have is of course some kind of evidence of that. That might be a vendor management piece, right? I mean, when they you check the vendor, one of the processes, show me your licenses, and understand that. I think the contract itself, you'll need contracts. Virginia has specific requirements that need to be in a contract. And it's not a lot to ask. It's just they're looking for very specific things. So you'll see more of that. So make sure that, ask the licensing question, have a good contract in place that kind of solidifies the relationship. And I think, and this is the critical point, and we'll all know this because it's an operational piece. Make sure that when you are operating, you're actually doing loans, that there's a way that anyone in your operations, whoever selects the loan processor, that they know that there is a select list or how to do it. They're not just hiring their buddies or whatever it is, right? There's got to be some discipline now in engaging the third-party processing companies at a loan level. So make sure you have that type of control as well. So that's what I'd recommend.
Vendor management, right? Like, it's like, oh my gosh, it's hitting everybody to some degree.
Yes, it is.
Greg,
it's never gone away. It's always there.
Right?
It's
yeah.
It's just sense, but Ray, as we know, common sense isn't as common as it used to be.
Well,
as we always believed it would be, it never was. Right.
Well, let me ask you something then, if I can, Nathan. I mean, I changed the subject a little bit, but I'm curious about this because you find at the beginning of the year with my clients is I get loan officers reaching out through me because we support them on things of, hey, I needed to renew my license. Well, maybe the 31st of December, they tell you, hey, I got to do this thing for my license. Could be education. The common sense would be that when it comes to licensing, we do it early, we do it complete, and we do it accurately. And sometimes I don't get a sense that with loan officers, less on companies, but loan officers, that they're as diligent as the regulators had hoped when they first threw down the SAFE Act.
Bless their hearts.
Yeah, exactly. Bless their hearts, right? So I mean,
so
what
Texan
have you seen? This is what I'm seeing is like we've got all this bit of education in the process, and I'm guessing you are just coming off the high or the low, however, from people clamoring to you guys saying, "Hey, I need one more class. It's like, dude, it's the 3rd of January or whatever, 5th of January. What are your thoughts on that, and
Yeah,
whether common sense plays on it and that kind of thing?
I was enjoying everybody's points, and I kind of forgot that I had points I needed to share too. So I'll just share them here, right? My hurdles for 26 is going to be this. I think that in the guise of shrinking margins, shrinking market share, shrinking loan officers, trying to make sure everybody's protected and collected and everybody's there, companies are going to depend on their loan officers and their processors and their underwriters, their people, to just know what needs to be done and make sure their stuff is taken care of. And it's not an unfair sentiment when you're in a professional licensed activity to know what it is to maintain a professional license. I mean, that kind of makes sense. But loan officers, I'm just going to pick on y'all, right? I am one of you. I actually let my license lapse in 2011 in Oregon. I didn't know how to turn it off when I decided not to lend anymore. And I'm not going back and doing three years of late CE in Oregon just to get my license back. That's ridiculous. So we are salespeople. We are builders. We're runners, and we don't necessarily slow down to see the small details. We trust other people in our processes to do that. We trust underwriters to catch the small details. I'm not saying it's right. I'm saying that's a lot of times how it works. And so to that, Ray, I'm kind of sidelining the question, but I'm going to get back to it. I think one of the greatest hurdles is going to be companies trusting their people to get their training done on time and efficiently. But one of the greatest wins that companies can make in 2006 with this is to see training as a culture builder, not a cost that they have to reduce. They should look for options, because if you're hiring training and you're just throwing them in front of the same old point and click, test out, you're done. What you're telling them is training's not important to you as a company. And if the regulator looks at it and looks at it like, why'd they spend 30 seconds in there and then they were testing? That doesn't make sense. What you're telling the examiner is that training is not important to you as a company. It's a checkbox item. I believe that culture and training go hand in hand. And so a big reason why MLO Force does the type of training we do, the podcast style with y'all, and include as many faces as we can, is because it's a culture build. If it's important to you, you'll make it important to your people. And if you provide something of value to your people, like I like to do chores around my property, right? And sometimes I do a honey-do list, and I need a tool, and I need that tool for one project. That's it. Well, I go to Harbor Freight because it's the cheapest tool I can get. It's it's less expensive than renting a good one, and I know I'll be able to use it for one chore, and then it's going to break. That's how a lot of companies view compliance training and CE and what they're doing, instead of seeing it as if I bought the better tool and had it for longer, I might use it more. I might have people go back and check into it and actually like recall information about it. So I see it there. Now, loan officers, the way MLO Force handles this, we turn off our training at I think it was 9 p.m. Eastern. No, sorry, it was 10 p.m. Eastern. On December 31st, because we need time to bank the last ones. And we got so many. We got a few emails on the 1st and the 2nd. I can't renew my license. I was in the middle of doing the training. It's like, I don't know how to tell you this, but the system in NMLS automatically flips over 11:59 and 59 seconds on December 31st. And anything you finish in the next year only counts for that year. It doesn't go backwards. I can't reverse time because you missed a timeline. So, we have to just continue to encourage our people, provide better training, provide better options, and then make sure they understand the importance of it. And then when you show that to your examiners, I think they look at you and go, oh, you're doing what it takes. Oh, guess what? That loan officer screwed up. I'm not looking at the company right now. I'm looking at the loan officer because they chose to do something poor.
Nathan, I love and agree with that so much, but everybody on this call knows in a shrinking market, when revenues are tighter, what's one of the first places that is reduced?
Learning and direction. It's L&D and learning and development always. Yeah.
And so I love that you said that it has to be a culture component and start at the very top.
But Dana, Nathan, Bob, and I think Bob and I, we've had these conversations in the past when we even started our training programs, and that's it's incumbent upon us to provide something where the training is compelling, right, and that it shows value. So we're in a position to if we're going to do it, because I understand, I get that. If you got the standard CE and it's boring, you're not, because you have to do it. If you get compliance training that's not required, they're not going to do it. But if it's at least like, look, I know I'm going to take an hour of your time, but trust me, it's going to be a good investment. It's incumbent upon us to give you the value, and then they'll come back and do it again. And I think that's important. So we have our work cut out for us, and I think we've delivered pretty good on that. And we will continue to do that, each individually and certainly as a group. But right. But I could understand that. I also understand, and you mentioned that loan officers, administration is not their strength, and to have them to administer 17 licenses, et cetera, while they're busy just really creating the business and doing what they're good at, I think it's hard to. It doesn't excuse them, but it goes back to it's incumbent upon the people around them to help them and shepherd them to get there. There are some that you just cannot shepherd any more than you have to get them to get it done. I respect that, but it's always who you partner with on the other side, because I think it's got to be respect that everyone's good at something, but we're not all good at everything. So I can't be overly critical.
Greg, I'm going to kick it back to you as we wrap this episode up. You talked about outdated assumptions. And so I'm kind of curious, because if I remember correctly, we are on somewhere around in 26, you'll be somewhere around year 6 of collecting and processing HMDA data. I think you guys started around 2019 on some of your older stuff. And I think we met in 2020, so I'm just counting numerically here. What are some of the outdated assumptions that have changed so much since when you first started this, or even in the last couple of years?
Well, I think we've called out some of them already when we've talked about, for instance, who's leading the market. And of course, we've seen the shift from depositories to independent lenders, but that's really coarse grain. There's a lot of them. There's a lot with respect to product market fit in each and every market, and this can be at the state level, at the MSA level, at the county level, the zip code level, and I guess it's not so much that I can summarize a list for you, but rather turn that around and make it a call to action that you have to update how you're approaching that question of product market fit in each and every market that you're playing in or that you want to play in. There's some surprising changes in leaderboard composition as you go into different markets, and leaderboard with respect to lenders, with respect to products, with respect to pricing components. What works in one market might not work in the other. And so I'm sure we can, as we keep talking, we'll distill some of those trends that we're seeing, but I'll turn it around for now and anchor it on a call to action that is the challenge, is to understand what's going on at the granular level, at the detailed loan level, as you called out our product line. That's what we specialize in, and that's why we specialize in it, is so that you can really understand the details of what's going on in each of your markets.
I would also put a challenge out to leaders on that, Greg, right, is to care about it, right? It's great to have a call to action, but the leaders of these lending shops have to care about it.
Yeah. Mm-hmm. They have to. I mean, there are good compliance reasons to care about it, but there's also good top line, bottom line reasons to care about it. There's a lot of change going on, which is what underlies your question, Nathan. There's a lot of consolidation. There's a lot of M&A, and you do not want to get
see more.
Yeah, yep. And you do not want to get blindsided. And I think that's the metaphor we like to use, is that you don't want to fly without radar. You got to know what else is in the sky and what the lay of the land is, because it's changing all the time.
Well, it's all good stuff. Thank you very much, everybody. Dana, you have any last thoughts? I'll go back to you. Anything as you were looking around, any last thoughts you'd share?
And listen, at the end of the day, if we just do good loans with good borrowers, we're going to have good returns. I know that just sounds simple, right? I'm a simple Texas girl. I just want to get back to the basics, right? And that philosophy applies regardless of the type of loan that you're doing. So I think if you can ask those questions and answer those questions in a positive way on the loans that you're doing, from the top of the house all the way to the end, then you shouldn't have an issue in an audit in front of a regulator.
I love it. Well, ladies and gentlemen, this is the Risk and Roll podcast. We are pleased to bring this to you. And just actually, we like to talk to each other, and so we record it for fun and posterity's sake. Bob, thanks for the great topic. Next episode, Raymond's going to bring our hot topic of the take of the time. He'll have to decide that between now and our recording in 2 weeks. So you've got your assignment built for you. Hopefully you get to go play some pickleball, because I know that's where you think the most.
Yeah, if only that were so simple. It's a lot of work to be done. So
There's a lot of work.
I wish I had time for pickleball. I've just gotten busy.
I love it. All right, y'all.
To pick up a pickleball paddle.
Well,
what?
Really?
Yeah.
All right, we're flying out to Texas.
Look,
we're going to change it.
Housing Wire, the Gathering. When we go there, we will play pickleball, because that's some of the things
this year. Yeah.
Be in Austin. So you got time to practice. We're on it. All right, y'all. Thanks so much for hanging out with us, and we'll see you in the next episode.